This week we're going to review the SPY, the QQQ, DIA, IWM, and MDY. That'll be the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average, the Russell 2000, and the Mid Caps. The major indices have broken support. They fell hard 2 days ago. They gapped down on news of the tariffs. A few weeks ago in this post, we had mentioned that we may have seen a low, but if the price went below the low, we could potentially see more downside. So here the total market index, which is essentially all the stocks in the stock market, the VTI symbol. We had mentioned that if the price falls below, then we will see more downside. We also mentioned it here for the NASDAQ 100 and the S&P 100. Well, as you can see in the charts, it definitely held for a while, a few weeks. It bounced off a little, and then the tariffs news came, and the market did not like it and gapped down on Thursday, and then it gapped down some more on Friday. So if we look at the weekly chart, it looks like the market price took a step downward, and a really big step downward. From here, this looks like the top of a step, and this is the down of the step. Here's the next step, and then go down. So let's review the last bear market to see what we may potentially see. In late 2021, we see the top of the staircase, and then we saw a step down, and then we saw a rally, which noted the top of the next step, and then it fell down. We saw two rallies. They're called counter trend rallies. So we had one that failed, and then another one followed that went higher but never made it above the 50-day moving average. So that was the next top of the stair step. So now we have two stair steps down, and then we saw more downside, and then it rallied to the 50-day and fell below. So never stayed above the 50-day. It did briefly, but not for very much. So that was the third step down, and then we had some more downside, and then the price rallied up. So there's the potential for 3 total down steps. That means we should be cautious about buying into 2 or more counter trend rallies. If you follow the dollar cost averaging principle, then you probably will continue investing throughout the entire time the market is going down, averaging lower prices. If you'd rather wait, hold that cash and wait till you see the price stay above the 50-day for a significant period of time, and you start seeing your first step up. So when the price fell below the 50-day, it stayed under there for quite a while, except for the first counter trend rally, which is what we just saw. The price did stay above for a bit and then fell below, and then it tried to get to the 50-day and bounced off downward twice. When it finally did get above, it stayed above for a few weeks, and then it fell below and came right back up, stayed above for a couple more weeks, and then fell below for a couple weeks, and then it came back, and then the price kept going up. So when the top of that peak forms the first stair step up, and when we see the price going above the top of the stair step, then it means that the price is recovering. And then what you notice when that happened, the price stayed above the top of the staircase. The 50-day moving average had been starting to slope up for a few weeks. So that's why we want to wait for investing cash that's not invested if you do not dollar cost average. It's possible that the market is probably following the COVID crash, very sharp downsides as you see here. If that is the case, the market fell down consistently for 5 weeks in a row, and then it hit a low, and then it had a rally up, and the following week it had a down week, but the price stayed on the upper half of the candlestick, meaning the price the following week never got below half of the price movement of the week where the low was sent. Then we saw a few weeks of upside, just green candle bars. And then it took a few more weeks, almost a month afterwards, to finally get above the 50-day. The 50-day moving average stayed flat and never curved down. Right now on the weekly, forgive me, I kept calling it the 50-day. It was actually the 200-day. This is the weekly chart. We saw the 200-day stayed flat during the COVID crash. And again, to correct my mistake earlier, we saw the price try to get above the 200-day and wasn't able to for very long, and the 200-day was sloping down. So right now what we see is the 200-day is starting to slightly curve downward. Getting closer on the daily, it looks like it's starting to curve downward, but it still looks relatively flat. So as of right now, the chart looks more like the COVID crash than the 2022 bear market. We will have to see how it plays out starting next week. Now let's review the QQQ. It tried to rally again, as mentioned last week. The price didn't get above the 200-day or even got close to the 50-day. The 50-day is sloping downward. The 200-day looks like it's starting to slope downward, but it's still relatively flat. The price broke support on Monday, but it recovered and it looked promising, and then Thursday and Friday it fell off hard. Very similar story with the Dow Jones, the DIA. This one's the stronger stock typically in a market correction, a downturn, or a bear market. The price did not get up the 50-day. It did briefly get above the 200-day, but sold off and tried to get back up, but then it found resistance at the 200-day and did not stay above it and sold off on Tuesday and Thursday. This is my first time covering the Russell 2000 ETF, the IWM. As you see, it's kind of started in the downtrend at the beginning of the year, unlike the other three indices. It peaked in late November and it's been in a downtrend ever since. By February, the 50-day had started sloping downward. So this one has been in a void essentially since mid-December. So the price has been under the 50-day. It's been under the 200-day for over a month now. And if we look at the weekly, it's now below the price of the last base. So this is as you see, kind of has a cup or a V shape. This is the last base. Then it had kind of an ascending price pattern, and then it fell. Now it's below this last base, which is at around, that started at the end of July. So this one is definitely in a void until a lot of things change. We want to see the 50-day starting to slope upward and the price getting above it. First, though, we want to see the price also get above the 200-day. Then next, we want to see the price get above the 200-day, and hopefully the 200-day does not slope downward. If it does, it's possible the price will continue going downward further. Next is the MDY. This is the first time I'm covering this. This is the S&P Mid Cap 400. Similar to the small caps, the IWM, it's been in the same downtrend since late November. The price has fallen below the 200-day over a month ago, and it's been below the 50-day for a little over a month. It did fall below the 50-day at the end of last year, and it tried to recover, and it did for a few weeks, but didn't hold it. It did go up and set a high above the 50-day, but it never got back above it. It had been starting to slope downward, the price, and then it eventually fell down. Similar to the IWM, this is in a void until we see the same conditions. Let's review the total market ETF, VTI. Similar story as the major indices, since it does cover the total stock market. It broke the support, bounced off it, looked promising, and then it sold off. So this VTI does give us a comprehensive view of where the entire stock market is, and it's in a downtrend, possibly in a bear market. We will see what this week tells us. Gold, GLD, had been in the chase zone for a couple weeks now. It had a nice period in the buy zone. For those of you who bought in the chase zone, we did mention that it's not ideal and you do risk losing gains. The buy zone is typically the ideal price point to buy to maximize your gains and reduce your risk. Once it exceeds the buy zone, goes past the last high, it's in the chase zone for 5% above that price, and you do risk it falling off. So you saw it went above the chase zone for most of last week, and then it sold off hard, and it's now back in the chase zone. Given the market volatility, it's possible the price may fall lower down into the chase zone and back into the buy zone. It's probably best to wait to see what the market is doing. Gold has been very strong. The 50-day moving average has never sloped downward. The price has been above it since the beginning of the year. So this one's really strong, and it may may present another buy opportunity if you missed it in the buy zone or the chase zone. Last week we had mentioned that silver SLV was still in the buy zone and it was worth considering. Unfortunately, we cannot predict the future and how the market will react. That's why we need to make decisions that based on our risk tolerance and decide when we want to sell before we buy. So if you did buy last week, it started looking promising. The price had opened lower than the last price. When I was considering buying this, I did not like that the price had fallen below. The price stopped the kind of the upward sloping pattern, and so on Monday I didn't like that it fell down and then decided not to buy. Tuesday it fell down some more, so I did not consider this. On Wednesday it looked like it was gonna go up, but it never went above the Monday high, and it was still below the last week's high, so I decided it was not worth buying yet. And then of course we saw on Thursday and Friday the market sell off, and it gapped down right below the 50-day moving average. If you had bought before you bought, it would be good to decide, when am I gonna sell? Am I gonna sell it if it falls below the 50-day, or 5% below my entry price, 10% below? It really depends on your risk tolerance. Or if you have a long-term outlook, it could be that you're gonna wait it out and see how the price recovers. I cannot tell you exactly how you should buy, sell, or trade. My goal is to show you what the market is telling us and give you indicators of what could be a good buy, and whether you buy or sell, it's really on you. So I shared why last week why I thought this was worth considering, and then in this video I shared why I chose it was not worth buying yet at the beginning of the week. Those are based on my criteria and my risk tolerance and my way of seeing what the market is telling us. Just to share, I did buy a ticker that I share with my PIM Pro traders who have a paid subscription, and the indicators, the PIM score told me it was a buy. It was in the green here, so I bought, and then the market sold off, and I made a mistake that I'm trying to overcome, but I still make every so often. I did not have an exit plan for this one when I bought, and now I'm down here pretty low as like the rest of the market. Last, we're going to cover Berkshire Hathaway. Like I've mentioned in the past, this is a stock that kind of represents market growth. So instead of having an ETF, you could buy Berkshire Hathaway as a way to grow with the market without having an ETF. We have been mentioning for a while that the price had been in the hold zone, and the hold zone is typically not the best time to buy. You've missed your opportunities. The buy zone was the time to buy, the chase zone was your last chance, and then the hold zone, your risk of losing is way higher. It's great if you've bought earlier, then you can hold, and you could set a stop loss to lock in gains. Let's say you bought down here at the bottom of the chase zone, or in the buy, let's say the top of the buy zone you bought, and you managed to hold it through and you're now in the hold zone. You could have set a stop loss that if the price falls below the top of the chase zone, then I'm gonna lock in a gain. So you see the market opened on Friday. This one was one of the last ones to get hit. It opened up above the chase zone, and then it fell hard down below the 50-day. Since the price did open up above the chase zone, it would have triggered right when the price fell below your stop loss order, and your gain would have been about a 5% gain, since the chase zone is a 5% window above the top of the buy zone. And that's it. It was kind of a discouraging week. I was hoping the market was starting to get familiar or accepting the tariffs, but I guess the announcements were not what the market was expecting, and we sold off hard. We will see in the coming weeks whether this is more of a COVID crash market scenario or a 2022 bear market. If you are in cash, I'd recommend staying in cash. I do advise not panic selling. You should be selling based on your own criteria that you have set. If you need examples on how to sell, I do have posts that explain selling gains and selling losses. Until next week, thank you. This is the PIM Trader.